Welcome back. The UAE Ministry of Economy and the National Statistics Centre stated today that the UAE's economy achieved a real growth of up to 4.2% in 2011 compared to 1.3% in 2010. His Excellency Sultan bin Saeed Al Mansouri, the UAE Minister of Economy, revealed a comprehensive review of data on economic indicators of the UAE for the period 2006 to 2011. Total gross domestic product estimates for the year 2011 at current prices amounted to 1.2438 trillion dirhams, a growth rate up 19.3% from its level at the end of 2010. The value of GDP for the country for the year 2011 in real terms reached to 981.7 billion dirhams, compared to a value of 942.4 billion dirhams in 2010. The rates of inflation of consumer prices for the year 2011 reached 0.88%. Officials stated that a rise in food prices and non-alcoholic beverages, a boost in services related to goods, promotions and culture, transport and education were all contributing factors. DIFC Investments has secured over $1 billion facility towards its $1.25 billion sukuk that matures on the 13th of June. The investment arm of Dubai's financial centre revealed the news in a statement on the Nasdaq Dubai Bourse website, stating that the transaction is a dual tranche Islamic facility and that the new 5-year loan is priced at 380 basis points, secured by the DIFC's Grade 1 property portfolio. The mandated lead arrangers and book runners of the facility are Emirates NBD, Standard Chartered Bank, Dubai Islamic Bank and Noor Islamic Bank. Moelis & Co. acted as financial advisors. The number of Emiratis working in the UAE's federal government sector passed the 50% mark last year, according to state media. According to local reports, a study by the Federal Authority for Government Human Resources revealed that the rates in the federal government sector jumped from 47% in 2010 to 53% last year. The number of nationals working in federal bodies rose 36% from 34% the previous year. A recent study showed that the public sector remains the workplace of choice for locals, with 90% preferring to work in a government entity. With that, let's now look at the stock indices across the GCC. In other news, the slide in financial markets from the past few weeks extended into last week, with equities, commodities and currency markets all closing well into the red. Investor sentiment was overshadowed by deteriorating liquidity conditions in Europe, fluctuating government bond yields and a severely crippled US jobs report. To get his view on the markets this week, we earlier spoke with Gaurav Kashyap, the head of the DGCX desk at Alpari Middle East.
Along with what we saw in Europe last week, we also confirmed that the US recovery has in fact stuttered with the most recent US non-farm payroll report on Friday. As a result of this report, once again, speculation and rumors regarding QE3 from the Federal Reserve caught fire, and this is why we saw the US dollar actually shedding a lot of its earlier gains in the week on Friday following the negative US non-farm payroll report. We saw gold moving above 1600 levels. And the US dollar generally remained on the back foot, and we can expect more of that happening in trading this week. Because of the fact of the weakening jobs report, the US dollar's moves should be anemic in trading this week. The euro will also remain a bit anemic because of the sovereign debt crisis. But looking at the economic calendar ahead, we expect to see a lot of volatility. This is because we have 4 central banks announcing their rate decisions. The ECB are expected to announce their rates on Wednesday, unchanged at 1%, although we will be watching for cues with regards to any easing measures on behalf of President Draghi. Also, the Australian Central Bank will be announcing their rates on Tuesday. That's expected to be cut down to 3.5%, which should weaken the Australian dollar. The Bank of Canada expected to remain unchanged, and of course the Bank of England wraps up the week on Thursday with their rate decisions. But it's very important to note that the economic conditions have extremely deteriorated since we last saw these banks meet, and we could be in for a surprise move on the downside for any of these particular banks when they announce their rates.